What's going on, YouTube? In this video, we're going to be talking about my top 3 SPACs that will make you rich. Now, I'm just kidding when I say they will make you rich. SPACs can be risky, so do your own research and know what you are investing in. But if you like that kind of content, growing your net worth with stocks and real estate, I am a real estate agent, then hit the like button and the subscribe for the YouTube algorithm to push this video out to more people so we can help their portfolios as well. Now, with that being said, let's get into these SPACs. Okay, so if you guys are interested in SPACs and you do not know about PSTH, then you guys need to. This is Bill Ackman SPAC. It is Pershing Square Taunton Holdings. I think that's how you say that. But we're going to get into this article about Bill Ackman and why he is so known now compared to all of history, like a Warren Buffett or something. So it says, by now the 27 million trade Bill Ackman, the CEO of Pershing Square Capital Management, placed earlier this year, is well known within the investment community. The flexibility of mind to short the bond market in February, mind you, when everything was crashing, February, early March, and net 2.6 billion, then pivot and go long the stock market in March to subsequently bag an additional 1 billion was legendary. It goes on to say, given the ROI and how quickly it materialized, Ackman's initial trade is considered by some to be the best trade of all time. So let's get this straight. He did $27 million into 2.6 billion. I save you guys the liberty of doing the math yourself, but 26 million into 2.6 billion is the equivalent of 96 times your money, or 9,600%. That would be like turning $96 into $9,600. So that is an insane return. So you can see why this SPAC is valued higher than the rest of the SPACs we're going to talk about. First thing to keep in mind, guys, when it comes to PSTH, is that there is no company PSTH has to merge with. They have been looking for companies. Bill Ackman was shot down from Airbnb, and you can see what happened with that. They just went public with an IPO. A lot of bigger companies are doing this. Now, there was rumors that he was going to take Stripe public, and that they came out to say they are not ready to go public. So this is valued at $4 billion, and the shares are backed at $22. And so basically, if the merger were to not go through in the next 2 years, the shares would be refunded at $22 and no higher or no lower than that. So with that being said, there is a little bit of risk here. There's about 20% downside from the current price. So just keep that in mind. But a SPAC deal merger has 2 years to go through. So this has until roughly August of 2022 to find a company to merge with and take public. If that doesn't happen, then you will be your shares will be liquidated at $22, which also does mean that the shares cannot drop much further than $22, right? Because if they did, why wouldn't everybody buy them up until $22 if they're secured with cash at $22? The risk to reward ratio on PSTH is just so much that you can't really ignore it, right? They're backed at $22 a share, and they're $29 a share, which represents about a 25% downside. And that's not too bad considering the possible upside could be multiples and multiples from the current share price or the current valuation. And with that being said, when Bill Ackman founded this SPAC and they raised the $4 billion to start it, Bill Ackman did not put a founder's fee in the original package in the writing. So basically what that means is he does not get paid until he merges with a company and takes that company public. As far as PSTH, I do not have a position in this SPAC. If there was a SPAC I was looking to build a position on besides in CCIV, then this would be the company I would do that in. And I say CCIV because I already have over $1,000 position in CCIV. So I'm not really looking to build out any other SPAC positions. It's all about risk to reward ratio in your portfolio and risk management. So keep that in mind throughout this video. Again, none of this is a recommendation to buy anything. So don't listen to me, do your own research. Now, if I were to put a price target on the SPAC, $22 is the lowest possible downside, and the highest possible short-term upside I think is around $35. The second SPAC we're going to be talking about is ticker symbol IPOE. This stock is a close runner-up. The difference between this company and PSTH is that this company is actually going to go through with a merger with SoFi. And SoFi, it is fintech company SoFi, or social finance, is set to go public sometime in 2021, in the first quarter of 2021. With the investment of a SPAC, a special purpose acquisition company, SoFi, which was founded in 2011, is well known for providing student loan refinancing. Previously, CEO Anthony Noto was a COO at Twitter and partner at Goldman Sachs. So he's a pretty accomplished individual himself. It says, in addition to helping borrowers secure better financing for student loan repayment, the company is also an online lender of personal loans and mortgages. Recently, it started offering both active and automated investing through its program, SoFi Invest. Rumors of an IPO through a SPAC started about a month ago, said the company confirmed the rumors according to TechCrunch. Little cool interface. I like the interface. I've never personally used them, but I could see why a lot of people would. When SoFi go public with a SPAC, SoFi is expected to go public through the SPAC route in the first quarter of 2021. According to a press release from SoFi, the deal has already been unanimously approved by the SPACs and SoFi's board of directors. The deal will need approval from SCH shareholders and any regulatory approvals. Social capital heterophobia holdings is Shampath. I cannot say his last name, so I'm not going to try. I'm going to butcher it really badly. But they have took a lot of other companies public. The Blank Check Company, he's a venture capitalist and billionaire. The Motley Fool reported that the SPAC raised about $800 million in an IPO in 2020 and had been searching for a company to acquire. Said his I don't know, is well versed in SPAC IPOs. He took Virgin Galactic public this way in 2019, as well as Open Door and Clover Health in 2020. When a SPAC, a shell company, raises money through an IPO to merge with a private company, the private company becomes publicly traded. SoFi joins the so-called SPAC IPO boom by merging with social capital heterophobia holdings V. The Wall Street Journal reported that U.S.-listed SPACs raised $82 billion in 2020, which was more than 6 times what was raised by SPACs the previous year. Gives Heterophilia credit for most of SPAC's popularity in the past year and a half. He raised $600 million for his first SPAC, Social Capital Heterophobia Holdings, in 2017. Social Capital Heterophobia Holdings is his third SPAC. Sorry guys, it is very hard to pronounce this guy's last name and even the SPAC company's name. It's a lot easier to use the ticker symbol. So with that being said, the Motley Fool stated that the SoFi deal is valued at $8.65 billion in the acquisition deal, which includes funds being contributed as part of the SPAC merger. TechCrunch explained that the deal includes $2.4 billion in cash. Half of the amount is from a confirmed private placement, $805 million from the SPAC's balance sheet, and additional funding invested in SoFi by T. Rowe Price. It says the company expects revenue of about $1 billion in 2021. Private funding has included $500 million raised in 2019, led by Quator Investment Authority, which is a private equity and sovereign wealth fund. So I think that's it on that. We're gonna go back to here and look at the good old chart. It looks like it came public November 30th at the normal $10 range and then shot up on the news. Now, this is only a $1.61 billion market cap, so even right now, in my opinion, it is very undervalued. If you're willing to take on a little bit of risk, say the merger didn't happen. but with all the successful past mergers, I think that is a very low chance, and this is why this would be a close runner-up. Now, getting into price targets, even at the $8 billion market valuation, that is like 5 times what the share price is now, 4 times what the share price is right now. So with that being said, the lowest I think it's gonna go is about the price right now, $22, and the highest I'm thinking around $60. I don't think it'll do the full valuation before the merger, but it'll get close. That'll be about 20% off the full value of the merger, around a $6 billion market cap. So with that being said, let's get into the next one. The third and final SPAC we're going to be looking at in this video is ticker symbol CCIV, or the name Churchill Capital. Now this is one of my favorites because the prospects of who this company is trying to merge with. Now they are trying to merge with Lucid Motors. Now if this were to happen, anybody buying this SPAC right now would get an insane deal on a very valuable company. I was hearing that this company is valued up to $15 billion. Mind you, they have never delivered a single vehicle. So the valuations are a little bit crazy right now, but this company is valued at $15 billion, probably because they have really cool cars and really cool technology. And I made a whole video about that. If you look at my prior videos, I think it's CCIV, best stock to buy now or something, because I think it is. I think it is a top tier SPAC just because of the prospects. They could merge with Lucid Air, and Lucid Air has been, like, now they have a job where you can apply to be the SEC, the form manager, and take care of all the stuff that involves public forms and being a publicly traded company. So with that being said, this SPAC is the worst as far as risk wise. Now I bought in at $18.50. I spent $814. So essentially my position would go to around $500, and I would lose about 45% of my position if the merger did not go through, or if it's never confirmed and just never materializes. With that being said, they could merge with another company, but this stock, this SPAC, is up so much from its original share price and kind of consolidating ever since the news was announced for quite a while now. So there is more risk associated with this one. We could see it drop down to $11-12, and that would be no thing for the SPAC world. So with that being said, these are my 3 favorite SPACs. I feel comfortable holding any of them, even though this one's a little bit more risky. I have my position in this one just because if the merger were to go through, I think this would be in the $40-50 range, and the risk to reward is worth it for me in my personal situation. So don't listen to me, do your own research. My price targets for CCIV on the low end is $11. If the Lucid Motors talks never materialize, never go anywhere, then Churchill Capital is going to $11 again. Now if they do, guys, if they do, my high-end price target is $60. My low-end price target is $50. This is before merger. My price target after merger, I would have to reevaluate, but would be about $100. So that's why it is worth it for me, and I will hold this one until something does materialize or it does not. So it's either it's going to do very well or it's going to do very bad. So with that being said, do what suits you best. Do not listen to me. This is my opinions, and I could quite possibly be wrong. It's literally a coin flip. It's 50-50. Flip a coin. One time you're going to be wrong, one time you're going to be right. So with that being said, guys, if you like this kind of content, hit the like button and the subscribe for me again. And if you're made it to the end of the video, then hit me down below in the comments what your favorite SPAC is. Maybe it's in this video, maybe it's not, but let me know down below. Get the conversation rolling, and until next time, guys, peace out.